What is going on, investors? Hopefully you guys are doing well out there. And we got an exciting podcast today because we are going to dive into the state of AI. As I'm sitting here today, I'm looking at the SOXX ETF, kind of the broad-based ETF covering the semiconductor industry. Also looking at the SMH ETF. Certainly over the past year, those have turned negative. And both are sitting pretty darn close to 52-week lows. So astonishingly enough, the semiconductor industry is sitting on 52-week lows, now has a one-year performance that is in the negative. But at the same time, we're seeing the AI giants saying that they are running short on compute power, with ChatGPT saying they're signing up millions of people per day, and the memes that are allowing people to create is basically melting the GPUs over at ChatGPT. Grok is saying similar types of things, saying that they are running short on compute. Google has indicated this as well. So where are we in the state of AI? Is the semiconductor industry, is the hardware industry forecasting this demand, or are they forecasting lower demand and lower margins? We'll discuss that on today's show. I've got a special guest, Mr. John McHugh, my co-pilot, if you will, over here at Equity Empire, making your debut here on the channel. John, how are we doing today?
Doing great, Colin. Great to be with you today.
Yeah, maybe give people the elevator pitch, those of you that don't know you. Some people have certainly experienced some of your stock picks. If you were a paying subscriber over the last year over at MarketWise, I think you had maybe a dozen or so picks that, we were both responsible for. Most of them went under my name, but you were behind most of them. And I think a good 50% of them went up 100%. And so people have certainly made money from you. But maybe give people just a quick background, those of you that are not familiar.
Yeah, absolutely. I started investing a little over 35 years ago. Started off as a rookie stockbroker. Moved on to become a healthcare analyst for a major investment bank that's now part of JP Morgan. Wanted to get more broad exposure to different sectors outside of healthcare. So joined one of my clients as a analyst picking small cap stocks. And that was the mid 90s. And I've been focused on small cap companies and small cap stocks for basically the last 30 plus years. Either on an institutional level with mutual funds. I actually founded and launched my own hedge fund focusing on small cap stocks, and traded my own personal account for the better part of 20 years focusing on small cap stocks. So that's my specialty. And I was excited to be working with you, Colin, a little over a year ago, because I just thought our research processes were just really, really synergistic. And the combination of your big cap focus with my small cap experience, I think provides our subscribers and those of you who are listening with something truly exceptional in the industry.
Yeah, and I mean, I think we complement each other quite well. I don't know a damn thing about a small cap stock. I do know maybe a thing or two about the large cap stocks, and so you fill in some of the gaps that certainly I don't have. I mean, let's just jump right into what's going on. And I would say we can focus on a couple of headlines that have crossed just over the past week or so. Like I said, if you're reading anecdotally from the ChatGPTs, the Groks, and these AI companies, they are telling you they're out of compute, that they are rate limiting people. They are not allowing you to use these things. If you're on Grok, if you're on ChatGPT, you're probably noticing sometimes it's not running as crisply as it has over the past, year or so. I've had to hit refresh multiple times to get the darn thing to work. It's basically, I believe we're making our way to where AI is crossing over into the mainstream. For the past year, most people that have used AI are turbo dork, and I say this affectionately, people that are coding, people that are using this stuff for their job, people that are on the cutting edge of technology. But the average person is not using AI. You call your college buddy who's, working construction or something like that. They're probably not using AI very often. but you call your computer science buddy and he's got Anthropic and he's got all the AIs up in every single window, and he or she is keeping track of every release date. And I think we're moving to the stage where your random buddy uses AI, uses it to make a meme, uses it to make a video at some point, uses it to do different types of things. So that's exciting from a use case perspective. But at the same time, John, we're looking at Nvidia stock, we're looking at the ETFs, we're looking at Broadcom, we're looking at AMD. A lot of these stocks are at 52-week lows. A lot of these stocks over the past year are actually down now. There hasn't been a lot of forecasting in terms of pulling in revenues, hasn't been a lot of, revenue revisions or any of those types of things. What do you think's going on in the AI market with the backdrop of the AI companies seem like demand is off the charts? And then when you look at the stock prices of the semiconductor companies, they've completely fallen apart.
Well, there definitely is a disconnect between the forecasting and the guidance that the big tech companies are providing with the investment community, because that hasn't slowed down at all. It's just been very firm. It's been just very robust. There has been no downgrade or actually even really a deceleration that they've been guiding the investment community to in terms of demand. So the disconnect is you would think that they just said that they lost their biggest customer, or that demand is falling through the floor, which we're seeing none of that. So my interpretation, I've given this a lot of thought especially in the last month, like what's going on here. But first, before we get into that forecast, I did want to mention that we were talking about a little over a year ago. We started talking about what happens when demand slows, and we also said that. And you've told subscribers several times already that the stocks are going to head down before the companies tell you that demand is slowing. The market will figure it out. They'll sniff it out earlier. But it's almost like the economist who has called 10 of the last 2 recessions. They just keep calling recession. We call recession for the last 10 years. Yeah, and every 1 out of 5 calls, they'll be right. It's the investment community seems to be doing the same kind of thing with their AI forecasting. And they're saying that it can't continue like this. Demand can't stay that robust. These companies can't keep growing 30, 40, 50%. And that's true, but could they continue growing 30, 40, 50% for the next several years? Given the demand signals that we're seeing, it's quite possible. So the disconnect is, typically sellers will wait till they see, like the battle analogy. Wait till they see the white of their eyes. So what is the white of the eyes of the AI demand starting to slip? We haven't seen it yet, and yet investors are just killing they're just selling their stocks with abandon. I mean, but they don't have a fundamental or information signal that's really allowing to do it. I think it's just confusion. It's confusion, and also like the old time investors, the investors who'd been through the .com boom and bust. They're trying to use that as a parallel. So they're going to use that as their analog. So companies like Cisco and Juniper Networks and all the companies that provided the switches and the routers and the infrastructure build out for the development of the internet, they're seeing the same. That's their playbook. That's all they have to work with historically, because there hasn't been a boom since the internet boom in the mid to late 90s until like 2020, 2001. So that's their analog, but it's not a very good analog, because the development of AI infrastructure is happening at a pace that's like 5 to 10 times faster than the pace at which they were building out the internet in the mid to late 90s. So they're using their analog is wrong. And I also think their timing is wrong, because in the it was like 95, 96, 97, they were all, the bears were all saying that the internet was a fad, that the companies like Cisco and the companies building out the infrastructure, the demand was gonna crash. And the stocks did pull back about 50%. And then they ran another 200, 300% from 98 through the year 2000. So you're not hearing that right now. It's just not the right environment for people to be making those kind of forecasts. And so they're assuming the worst. They're assuming that that AI is maybe not a fad, but it's maybe the spending is ahead of itself. Maybe that's the assumption. But all of these things are adding up to a lot of fear, a lot of confusion. What is it? FUD, fear, uncertainty, and doubt. And when there's a lot of fear, uncertainty, doubt, which is prevalent across the entire market right now for a broad range of reasons, both specific to certain companies, but also broadly to the economy, the political economy. With all that uncertainty and doubt, people they're acting emotionally, and stocks are going down, and it's causing them to panic. That's not the best time to be selling when you're in an emotional state.
Yeah, I mean there's no doubt about that, and we've seen this in technology a lot of different times. You brought up the internet, and a lot of people watching might not remember those days. They might be too young to remember those days. But another time that it happened is the iPhone was released in 2007, the original iPhone, and it was a high-end device that required a high-end cell phone connection from AT&T, and so it was relatively slowly adopted, but it obviously ushered in a whole era of new mobile web internet and social media and websites like Netflix, websites like Uber, and multi-hundred billions of dollars, trillions of dollars has been added to the tech sector, largely because of the iPhone and mobile web and cell phones and Android and those types of things. Well, it just so happens in 07 was interrupted, and that whole phenomenon was interrupted by a great financial crisis in 08 and 09. And so these types of things can happen. I don't know if you're making a macro call on these types of things. What would you recommend, the average person sitting out there? And I would say probably the average person watching, maybe not necessarily the average person watching a show like this, because they're deep in the weeds in semiconductors, deep in the weeds in AI, but in general, they probably have looked back over the past 2 years and they might have been underallocated semiconductors, or they had a little bit of Nvidia. They had a little bit of some of these stocks that are performed relatively well. And yes, they've pulled back, but if you bought Nvidia 2 years ago, a year and a half ago, you're probably still sitting on well on above average gains, certainly compared to many other stocks and maybe even the broader markets. Is that investor, should those investors step back in? Is this a moment where you step back in, or is there some kind of all clear sign that we need from either the macro economy, the broader markets, or the AI markets for me, the investor, to feel comfortable being like, okay, yeah, I'm going to go buy some Nvidia stock at this point, or I'm going to go buy one of these broad-based ETFs? Is there a sign that we're waiting for, or is that sign already out there?
Well, first of all, use an interesting word, trying to a small investor, or novice investor, or part-time investor, or just a hobbyist investor, would when you're trying to look for entry points into semiconductor stocks, and you're looking to feel comfortable, it's just not going to work. Semiconductor stocks bottom when there's the most amount of uncertainty, which is very similar to the environment we're in right now. Not saying that calling a bottom here, but we're heading towards what maybe it's near term, maybe it's a little bit more intermediate term. Maybe we've got some more downside to continue. But the point is, in my investing career, in trading semiconductor stocks, the time to buy was when you're most uncomfortable, which is you almost have to flip your emotions when you're, especially in stocks in general, but especially with semiconductor stocks, because they bounce well before you get the all clear signal from the industry or from any of the companies, whether it be Taiwan Semiconductor or Applied Materials, ASML. these stocks bottom well before you get the all clear signal on a fundamental basis. So if that's the case, I would just focus on the names that you've been talking about every Friday for the last 3-6 months. You've been very clear about the biggest and best and the strongest, the number one, the top player in the specific sectors that you've been focusing on. And when they're down 30 to 50%, that's when you start nibbling. Maybe that's not going to be the bottom, but that's where you start to accumulate. And there's a phrase that I love, that it's an old Wall Street cliche, and it's a quote from the original J. Pierpont Morgan, the founder of J.P. Morgan. In a bear market is designed to move stock, to transfer stock to its rightful owners. In other words, those who really believe in the company long term. The rest are just tourists. They're spectators. They're traders. They almost don't deserve to have the long term benefits if they're not willing to ride out these turbulent times, or to actually, ideally, if you got cash available, to take advantage of them.
Where do you think we're at in this hardware cycle? We've talked about this quite a bit, and we've seen it throughout technology. You can go all the way back to the personal computer, when the personal computer was at one time the hottest gift and the hottest thing that you could get. And then those days, personal computers may more or less become a commodity, and they're giving them to kids. They're giving laptops to kids. I remember when I was in 7th grade, like a laptop was like the coolest thing that you can have. And now they basically just give those away for free. And during the internet kind of build out, you had to buy a rather expensive modem, a rather expensive PC. You had to upgrade your hardware every year, every other year to experience kind of the full aspect of the internet. We've also seen that with mobile phones as well. The iPhone was a must-have type upgrade for many years, and then it became kind of a must-have upgrade probably every 2 or 3 years. Now we're in a cycle with the iPhone where it's like you don't really have to buy a new one if you don't want to for probably several years, unless you just happen to want the latest and greatest. And both of us are assuming we're going to get to that place at some point in AI where you don't if you're Amazon or if you're Google or if you're one of these data center providers, you are going to probably constantly be upgrading your stuff. But the nuts and bolts of the traditional cloud over at AWS, it gets upgraded every year, but it's not a must that AWS every year is like, oh, we got to go get the latest AMD or Intel CPUs to run our traditional cloud or whatever. I think we're in the midst of a must upgrade cycle as it relates to Nvidia. You're going from the Hopper to the Blackwell, and just from all the turbo geeks that I talked to, the server engineer guys, they're like, hey, it's good. First of all, it's going to take a while for those to matriculate their way into the hands of the different clouds. It's also going to take a little while for the server engineers to tune those up. It's very similar to, I don't watch a lot of Formula One or NASCAR or any of these types of things, but you get really deep into the weeds on these things. And it's the teams that are really fine tuning their tires and the spoilers and all this other stuff. Like, you realize, like, hey, all the cars look exactly the same, but there's a reason why certain teams win. And it's because they're finely tuning these types of things. And my understanding is the Hopper is a finely tuned race car at this point. And the server engineers have figured it out, and they're running it optimally, as close to optimal as possible in the server environments that they're operating in. But the Blackwell is first of all, it's going to take a year until you see kind of mass shipments of those and get those widely available. On top of that, it's going to take about that long, maybe even a little bit longer, for these server engineers to finely tune these things and get these things running at the capability and the speeds and the performance that is promised by Blackwell. So, in that sense, I look at this and just as a casual observer, I'm looking at this. I'm seeing ChatGPT melting down. I'm seeing Grok melting down. I'm seeing the casual person not even using AI. And I'm thinking to myself, man, we probably got 4 more years, I think, of this hardware build out where its new version comes out, takes a year, maybe even 18, 24 months for those to become widely available. Takes another 6 to 12 months. I'm not a server engineer, but I'm just guessing. Probably takes another 6 to 12 months for them to fully optimize those things. Could take a little bit longer with Blackwell. Could shrink it down a little bit. But to me, I'm looking at this and I'm thinking, man, we've got probably a couple more years left. This is like the early days of the iPhone. This is like the early days of the personal computer, to where you can buy a personal computer and a year can go by and the one that you bought a year ago is completely out of date. And if you want to stay on the cutting edge, which the Googles and the Microsofts and the Amazon certainly want to do, you're going to have to upgrade. But the stock performance is not acting like that. And so all the evidence that I am seeing is that the Nvidia chip is like the iPhone 1 or 2 or 3, and that you are going to have to continue to upgrade, and that the demand is going to be there for these chips. But then again, you're looking at the stock performance of Nvidia. It's not quite at a 52-week low, but the shares have basically gone sideways for quite some time now. So what are your thoughts on where we are in this hardware upgrade cycle? And do you have any thoughts on why the stocks aren't reflecting what seems to be a rather obvious thing? And that what are we missing? If this is what seems to be very obvious, are we missing something as it relates to the hardware build out?
Related to the build out, I would once again, I know that a lot of viewers are either were too young or just weren't involved in the markets at all in the late 90s. But when they were building out the internet, it was the initial stage of the build out of the internet was from the early 90s to the year 2000, before the infrastructure was built out enough to handle all the apps that they had available to use the infrastructure that they built at that time. And once again, in I believe it was like 96, 97, there was the same kind of price action. So almost every single company involved in the internet build out, the infrastructure build out, was down 30 to 50% without a whole lot of fundamental reason for them to be down. They had just run very similar to what's happened in the last couple of years. When you look at how much Nvidia has risen, when a stock triples, quadruples, or more, it can pull back 30 to 50% for no reason whatsoever, like zero fundamental reason, other than it just ran too far too fast. And then a narrative comes out that it's almost like the press will start looking for a reason why. So they're going to look for every reason why. So any headline that says that demand could be decelerating, the press is going to be all over it, and that's going to cause not only smaller investors to start selling, but the big investors do too, because they've got pressure to perform on a quarterly basis also. So that happened in 97, and then the numbers. What happens though is that as the next few quarters were very strong, and demand was not only did demand meet expectations, but actually continued to power much higher than expectations. That's quite possible right now, because expectations, people just have no idea. I don't know. You've got your network of the geeks and those who are in the trenches, kind of the engineers that are either working on the apps or actually building out the infrastructure, both on both sides. I've got those kind of connections too, and almost even the most informed just don't have idea how big AI could be. So what's happening is it's going to be a lot bigger than the internet build out. And the same kind of thing happened in the like I said, the 96, 97 timeframe. It feels kind of like that now, where there's a lot of uncertainty. The stocks are, these high flying stocks. Anything in the AI space is down 30 to 50% or more. Like anything, it doesn't matter. I looked at a company over the weekend. They're growing 100% a year. Like nothing has changed. They just got they got one of the top 5 big tech companies as a new customer. Company is going to invest in them, and the stock has dropped 30%. It doesn't matter how the companies are performing fundamentally right now. They're just selling them due to the uncertainty. And then there's also the macroeconomic issues, which we can either talk about on this call or we can talk about on a later podcast. But for whatever reason, the uncertainty is the focus of investors now. And when they're uncertain, they're not going to pay up for that particular stock. And oftentimes they'll just simply sell it. They just don't have enough. There's just not enough short-term clarity for them to get the stocks to head back up. Now, where are we in the cycle? If I were to, my read right now is somewhere kind of like the internet, like the Cisco's were in 97. In other words, 30 to 50% pullback is where they were, kind of where we are now. It was not a V bottom. It took a few months or more before they started heading higher. But when they did, they doubled and tripled again. After everyone said that the demand was pretty much that there just wasn't going to be enough demand for them. So that's where I think we might be in the cycle. Timing wise, no one rings a bell at the bottom. And we probably do have going on. I'm not sure what your thoughts are, but I think we might have some more downside action before we head higher. But we're kind of feeling for a bottom. A lot of damage has already been done. I wouldn't be selling here. I just wouldn't be selling here. Like the time to sell was a month ago. And I do think there's another big up leg coming. It's going to be surprising. It's going to be way bigger than anyone thought. And you've got better vision on that than just about anyone that I've worked with or any of my contacts right now. So I think what you've been talking about in the last several weeks on your channel have been I think they've been very insightful, kind of visionary, very well informed. And I'm just trying to kind of build on that and kind of get my own data points that either would support it or challenge it. And right now it's more supporting than challenging.
Yeah, I would say that, a lot of people are like, well, where does this AI go? We've got these chat bots. They answer questions for you. Some people might say it replaces some Google search results, those types of things. That's all well and dandy. But it is basically internet 1.0, where you had listservs or you would dial up and you had just strictly text communication. As it relates to the internet 1.0 was strictly text communication, and it was occasionally sometimes slow. We remember the dial-up internet days. So slow was an understatement compared to today's speed. Mine's me very similar to my experience over the last week using AI. It sometimes is slow. It works very well, but it primarily works strictly in text form, which is obviously amazing. But we know how the progression is moving. We saw it with OpenAI as they released their meme generator image type of thing, and it's basically melting down the site. And so when you start to usher in images, that will usher in a larger group of people, because there's only a certain segment of the population that need to use AI to code, that need to use AI to write some essays, need to use some AI to ask some kind of question or query some data, or, and I say this affectionately, only the turbo super geeks of society are using this stuff. It is not until it crosses over into the mainstream where you have memes being generated by this stuff, where you have a lot of customer support that is AI generated, where, maybe some banking decisions that you might have are using AI. There's so many use cases. You go to the doctor instead of the doctor, analyzing your images. It's all being done by AI, and on and on and on down the road. And so the bar that the AI industry has set is something called AGI, artificial general intelligence. And again, that's like a super geeky way of analyzing this. And that is fine. Where I would put the bar is curing cancer. Like, that's literally basically the bar of AI, is that until it cures cancer, there's going to be companies that are going to throw money at this. Now, what this doesn't mean, this is a really important point for a lot of investors out there, is what this doesn't mean is that Nvidia's margins are going to be sitting at 75% out into infinity. Okay, just like I don't know off the top of my head what Cisco's gross margins were in 1997, but if I were to take a crack at it, they're probably pretty damn good. Okay, go back to 1970 whatever, and the first IBM computer comes out. My guess is those things probably sold for like $2,000-3,000, which is in those days, $2,000-3,000 was probably over $10,000 in today's dollars. My guess is IBM's gross margins are pretty damn good. But what happened in both of those cases is the hardware margins get shrunk and shriveled out. And in the case of Apple, we've seen it where their margins have stayed relatively steady on a lot of their physical and hardware products. But if it wasn't for introducing software and the services segment of Apple's business, on top of the buybacks and the other things that they've done over the company, I don't think shares would have performed as well as they have over the past 5 or 6 years. It's really been the addition of $25 billion worth of quarterly revenue that comes in through software, which has gross margins sitting at 70 or 80%. That has really boosted Apple's revenues because they are having trouble raising the price of the iPhone as it relates to input cost and component costs. They're having trouble maintaining those margins, or really not necessarily trouble maintaining, but they can't expand margins on a phone any more than they probably have already. So the same case is going to be true with Nvidia. I fully believe that the Googles and the Amazon and the Microsofts will continue to throw money at different types of server equipment until cancer is cured. And whether that happens in 5 years or 50 years, I have no idea. But what we do have a clear understanding on is, number one, the demand is going to be there. But number two, and this is what investors could potentially be weighing right now, I think it's probably a little bit of a mistake, is that the margins are going to compress. And that, yes, Nvidia could be the iPhone of the GPU or the IBM PC of the GPU, but 3, 4, 5 years down the line, China will have reverse engineered this stuff and they'll have some chips. AMD makes fine chips. We know the story over at Broadcom. They're working with these companies very closely, and they're making custom GPUs and TPUs based on the customer demands. And we just know that the technology is going to continue to progress. So if Nvidia wants to maintain a leadership position, what are they probably going to have to do? They're probably going to have to give some price concessions. Probably not going to be able to print 75% gross margins for the next decade. I mean, if they do, if demand is still off the charts and Nvidia can print 75% gross margins for the next decade, I mean, the stock's probably undervalued by a factor of 10. I just don't believe I don't believe that is going to happen. I believe a lot of that is already priced in, and what is currently being priced into the stock is a little bit of a more normalization, not of demand, but of margin. And not necessarily through the first wave of Blackwell, but we're probably moving already into next year where a lot of investors are stepping in. Because like you said, the people selling these stocks could be a little bit of profit taking, could be a little of locking in performance, but the incremental buyer of Nvidia is looking out a year, 2 years, 3 years from now. And they're saying, how are we going to go from a $3 trillion valuation on this, or whatever it stands today, maybe $2.8, $2.5 trillion valuation on this thing? How are we going to get to 5? over the next 3 years or so, which would be like a 30% CAGR for the next 3 years, which would be reasonable. Not just reasonably, that'd be like really, really great performance.
Yeah.
But how are you going to be able to do that over at Nvidia? And on top of that, have the progression of hardware where margin gets drained out of the business. Now, is Nvidia going to have to transform their business a little bit? We just saw CoreWeave go public this week. Obviously, they don't have a majority stake in the company, but there is a way for Nvidia. What if Nvidia over the past year, instead of selling their GPUs, they just put it in their own facilities and then rented these damn things out? I mean, how much, the top line revenue wouldn't look as sexy, but my God, their annual recurring revenue would be off the charts. We would never even seen anything like this. People would be locking in for the next 4 or 5 years over at this company. What do you see, like, just broadly? I know I just spewed out like 9 different things, but just broadly, I mean, you've seen these things happen before where the margins in hardware get drained, even in top end hardware like the iPhone, even with some PCs and those types of things. We've just seen that the gross margins that these companies make, and those of you that are not familiar with, every dollar that Nvidia brings in, 70 cents, 70, it's closer to 75 cents, is gross profit. So if you're Google and you just spent $5 billion, or maybe a better example is Microsoft, you just spent $5 billion on Nvidia GPUs. 75% of that spending is not actually the GPUs. It's actually the gross profit. It's the markup that Nvidia has put on the product. So that seems to me there's a hell of a lot of room there for an AMD to say, I don't need 75% margins. I could live with 50. And then Broadcom come in there and say, well, we don't need 50% margins. We could live with 35. And this is what's happened over the history of hardware. But broadly, what do you think about these margins? Do you think this is contributing to the selling pressure? Those types of things?
Those are the kind of concerns are definitely adding to the selling pressure. You use a key word there, which is recurring. So large investors are the way they value a company is by forecasting out the cash flows of the company, adding them all up as far as they can go out, and discounting them back at a risk-adjusted rate relative to the 10-year Treasury bond. That's kind of complicated finance. Don't need to get into that. But to do that, they need to be able to forecast the cash flows. And like a guy like Warren Buffett can forecast the cash flows for one of his big holdings, Coca-Cola, because it's really easy to forecast what the cash flow is going to be 10 years out from now. I don't think anyone could possibly forecast more than just even a couple years out for anything that's really related to AI, like with a range of with a reasonable range of expectations. It's just a little too random to be able to forecast that out, and so they're going to demand a discount on the valuation for that lack of forecastability, let's call it. Regarding the gross margins being sustainable or not, I absolutely agree. Also, it's very likely that there is going to be gross margin pressure because the companies buying the Blackwells, like you said, the Microsofts, the Googles, Elon, anyone who's buying those either the Hoppers or the Blackwells, their number one focus right now is to put them into a cluster that is super, super efficient, because Jensen, NVIDIA's CEO, Jensen Huang, recently said that AI growth is going to be capped by their access to energy. And that is limited. So the growth prospects for the intermediate term they're kind of capped. And so there's two things that are going to be vital for the companies that are going to be provide the greatest growth opportunities, I believe, in the next 3 to 5 years. Those are the companies that create networks either the most efficient data center that's using Hoppers or Blackwells, or some kind of AI network some kind of server configuration, some kind of server design, like a creative server design. They're going to have to be really, really creative to create these clusters or networks of devices that process data quickly, but don't suck up a lot of energy. So that would, it's not clear exactly what those plays are right now. We're researching both the big ones and the small ones. But I think those are going to be the greatest opportunities. And then there's going to be great opportunities either in the delivery of the energy, the generation of the energy, the delivery of the energy to the data center, and to the backup storage of the energy for times when, because it's hard to predict exactly when that energy is going to be needed. So if I were to guess, at least on the small cap side, it's going to be a bunch of names that no one's heard of yet. On the big cap side, it's probably going to be the names that you've been focusing on, because they're going to be, they're spending, like you just said about Microsoft. You know that Microsoft has some kind of R&D lab trying to make their configurations of the Hoppers and Blackwells as efficient as possible. So they're the most likely beneficiaries. The small companies digging literally every day trying to figure out which ones they're going to be. But when they do show up, we're going to be sharing them with you, the viewer, and our new subscribers when we come out with our new product.
I would say going forward, the easy money, and we'll put easy in air quotes, easy money was made in semiconductors. You could have just blindly bought any semiconductor company, including Nvidia, and made money. Now I think you need a little bit of more forecasting and a little bit more belief in what you're seeing in the marketplace. And it's not going to be for every investor. Whereas in the past, it was kind of a no-brainer. It was, okay, this is obviously a trend. At least it's going to go for a year or two. These hyperscalers are going to spend a bunch of money on these GPUs. They're in short supply. Nvidia has dominant market share, so it's going to skyrocket. Now you start to look forward 2 years, these doubts start to creep in. Now, me personally, I still think we are in the, baseball season has just started, so we could use some analogies there. I still think, I don't even know if we're out of batting practice quite yet, because we are just getting into memes as it relates to AI creating memes. We're not even really at the point where the AI is analyzing, CAT scans or MRIs. It's being done a little bit, but it's not being done in a massive way yet. And so what's the compute power going to be required when it's also tax season as we record this? What's the compute power going to be required when everybody's taxes is being not only completed, but also audited via AI? I don't know how many taxpayers there are. I know that not everybody pays taxes, but what's the compute power that's going to be required there? Or when governments start to run their armies. So instead of having these armies that are primarily human based and rely on satellite communication and these types of things, what happens when the AI is the one making a lot of the decisions and making a lot of the communication and moving assets around a battlefield, or moving drones in and out, or the aircraft carriers or whatever? You know what I mean? Like, we're still in like the analog age in a lot of ways as it relates to the build out. And I know Jensen Huang, I think he did his talk. Actually, I've got a clip here. I'm going to play this clip because it goes off what you just said recently.
Because remember, one big idea is that every single data center in the future will be power limited. Your revenues are power limited. You can figure out what your revenues are going to be based on the power you have to work with. This is no different than, like many other industries. And so we are now a power limited industry. Our revenues will associate with that. Well, based on that, you want to make sure you have the most energy efficient compute architecture you can possibly get.
So when he said this was probably the most, I don't know, bearish is probably not the term, but when you watch Jensen, he's like full pump mode. He's like, the more you buy, the more you save. The hyperscale, and I think in the same talk, he said, hey, in a year, the hyperscalers are going to send us $1 trillion. Not over the course of several years. He said in a single year, there'll be $1 trillion of spend. So in one side, and this is why it's confusing to some investors, because you listen to Jensen Huang say there, like, hey, your revenues are going to be tied to the amount of power generation, and we don't need to go down that rabbit hole. But if you start curing cancer and you start doing all this stuff with AI, powering your army and all this stuff, there's not enough compute power, let alone energy, physically available on the grid in order to do that. So we're several years away from that. But in the same sense, in the same talk, he said that the hyperscaler is going to spend $1 trillion, which I mean, I don't know where we have to get to for these companies to spend $1 trillion. They don't have $1 trillion in combined revenue, let alone, as it relates to AI. So I don't see them necessarily spending that anytime soon. But this is the difficulty that we sit ourselves in as an investor. And it's kind of been this euphoric phase where it's AI is this new thing. It's cool. We're making money. Now the adults have to sit down in the room and make these tough decisions. And I think, like you said, the paper hands and the money managers that want to lock in performance, and the people that may just have gotten in on the trend because, trend investing is a real thing and it's actually a very viable way to invest. Those people are stepping to the sidelines. Now you have to make the decision. Is this sustainable from a revenue growth perspective? Is it sustainable from an energy generation perspective, as we just heard from Jensen right there? Is it sustainable from a gross margin perspective? And is it just sustainable from the hyperscalers perspective? Is it sustainable considering the three largest ones have core businesses that all get disrupted, maybe in either a minor way, like maybe Amazon's e-commerce business? How is that disrupted by AI? Maybe only in a minor way. In fact, it might help because we're seeing a huge consolidation of retail here in the United States around basically 4 retailers handling. I don't know what Costco, Walmart, Target, and Amazon represent, but you've had Party City, Big Lots, Joann's, on and on and on down the line. We're seeing retail basically just close up. And so maybe their business isn't disrupted by a lot, but AI is certainly disrupting, or what most people believe is the traditional search business. How does that disrupt Google's core business, which is search advertising? Microsoft has been selling the same software for 50 years. So how does software where I can have the AI do a lot of the things that most of Microsoft's Office suite does, how does that change things? How does the operating system change if it's powered by AI instead of having Windows or Mac iOS? What if when I turn on my computer, it's just an AI operating system with some underlying UI run on Linux or one of these other things? So I don't know. I just think that we're moving into this era where things get very interesting from an investment standpoint. I stand by what I believe is that this is a shorter term, and shorter term could be 6 months. Shorter term could be a little bit longer than that. I remember when COVID happened, the March drop happened, and I was like, wow, this is really exciting. Not that people were getting sick and all that stuff was exciting, but from an investment standpoint, it was exciting. And I remember sitting back and being like, well, this is a pandemic. This is going to play out for a long time. People are going to be sick. And I was like, the downside is this is a pandemic that wipes everybody off the face of the earth. So your downside is everybody dies. So there's no reason in that scenario, there's no reason to hedge to the downside, because either your E-Trade account matters or it doesn't. And so there's no reason to be like, oh, I'm moving to the sideline because of COVID. Okay. Now, what I misjudged there, and that was an accurate assessment, I believe, in hindsight, obviously. But what I misjudged was the speed of the rebound, because we all remember that the pandemic came down. I remember I started nibbling on some stocks, but I was like, I've got a year. People are going to be at home. I vastly underestimated the rebounding. And so those are the things that I'm weighing now as I'm seeing these stocks, like you said, that are sharply, moving lower. We're looking at a lot of these small cap stocks, like you said, that are not designed into data centers today, but 5 years from now, many of these small companies will be relatively well. I mean, as we sat here a year and a half ago or so, and we were making decisions on, hey, what little companies are going to make it into the data center that everybody's going to know? We came up with like a Vertiv, we came up with a Credo, and if you're, super into the weeds, both of those stocks have really done well as it relates to getting designed in a certain way, particularly as it relates to Vertiv, very much getting designed into the data center. And so we're making the same decisions now, like 5 years from now, what stocks are going to be moving into the data center. And I'm seeing these stocks down big time. And so it's particularly exciting. But at the same time, how long does that last? Let me ask you this question, John. We obviously saw with COVID that the rebound occurred because the federal government, not only here in the United States, but across the world, basically wrote a blank check to society, literally started sending out checks. Okay. Now, barring that happening, which there probably are some scenarios where checks get written. And if it does, then I think every investor is well trained on what they should do in that scenario. Let's say that doesn't happen. We don't have this like check being signed by Donald J. Trump or whoever's running Europe or wherever. What is the sign? What is the sign that you're going to step back in? Because like I said, we've probably got 4 or 5 names that we're damn sure these stocks are going to be designed into the data center in 5 years. But we're seeing these things go down like 15% a week. What's the sign you're looking for? What is it a technical reversal? Is it Trump finally moving on from tariffs to something else? Like, what is it that you're waiting for?
I'd be looking for several things. The most obvious visually, because we're both technical analysts and we like to look at charts, not because of their, I'll use your phrase, which I thought was very clever. We're not trying to be Miss Cleo here. This is not reading a crystal ball in the charts. We're not reading tea leaves in the charts. All we're doing is looking at past price performance. The charts don't tell you, they're not going to tell you anything's going to happen in the future. They will tell you what price has done based on what kind of market environment you're in and the sales and earnings growth of the company. That's what it's going to reflect. So the chart doesn't lie. It is the truth because it's where transactions had occurred in the past. And it's good to know. You talked about this on your most recent most recent video. It's good to know where price has been. Like, why do you look at charts? For the same reason you look for, if you're going to sell your house, what is the price range of transactions in your neighborhood? Every realtor in the country, it does exactly that. You want to know what something has been worth and what it's currently trading at. It's basically relative value. When we are making recommendations, we recommend something that is relatively cheap based on its future sales and earnings prospects. And when it becomes relatively expensive based on those metrics, then we either move to a neutral stance or actually start recommending to get out of those positions and look for something that's cheaper. So I ran a hedge fund. What a hedge fund does is a hedge fund is constantly moving so I ran money for a large number of both institutions and wealthy individuals. And it was my fiduciary responsibility to cater for that capital to generate the highest return possible for them, taking the least amount of risk possible. That's what a hedge fund manager does. And as such, the hedge fund manager is going to look for those situations in any financial market where the reward potential is substantially greater than the risk. So that would be something that I'd be looking for now. Two things we could look for. Where are we broad stock market? The broad stock market, the S&P 500 index, the most widely looked at index, the most widely benchmark index for fund managers. The S&P 500 from the low of October of 2022 until January of this year was up 70%. Most people don't realize that. It was up 70% in 2 years. The S&P 500 has averaged a 10% return annually for the last 60 years. So 70% over 2 is way above a normal return. That's just the broad stock market. The thing that was driving most of those were AI related and tech stocks. A lot of those were up a lot more than 70% over those 2 years. So some kind of corrective action or retracement, however you want to describe it, some kind of pullback, whether it be the technical definitions of a correction is in the 10% range pullback, and the technical definition of a bear market is when the broad market is down 20%. The S&P 500 as of Friday, I didn't see the close today in preparation for this presentation, but was down less than 10%. So still in corrective territory, but not anywhere near a bear market yet. So could we have more downside for the broad stock market? Absolutely, we could. Just as a normal corrective action based on a 70% bull market for the last 2 years. Forget about everything else. Just like this is just market mechanisms. This is the way the markets work. They go in a bear market, in a bull market, they increase dramatically, and there is in every bull market, there's a corrective period that follows. That could be a small correction. It could be intermediate, or we could get to bear market territory. Those are all ranges of scenarios that I'm currently considering. Like I said, we've retraced 10% of a 70% move. Why is that important to tech stocks? It's important to tech stocks because the broad stock market in a bull market, the rising tide lifts most boats. So most stocks are going to go up in a bull market. 70, 80%. It's the most important thing to look at when you're deciding to pick a stock is what is the broad market doing? When the market is in a corrective phase, most stocks are going to go down. Like I like to ride my bike with the wind. I do triathlons and I'm on my bike a lot. And I hate when there's a headwind. It's so easy to ride. I feel like well, maybe not Lance Armstrong isn't the best example, but feel like a Tour de France champion when the wind is at my back on a bike. You want to think of it that way when you're investing. Like, yeah, we're always looking for a company that's doing great on its own. We analyze companies company by company. What are the specifics with the company? What are their products or services that they're coming up with that are going to make them amazing over the next 2, 3, 4, 5 years? We're always looking for that. The companies that even do that will still go down in a bear market. And that's kind of what's happening right now. So that's one thing that I'm considering is where have we been and what have we? How much correction do we have? A second consideration, Colin, would be even more important than that, which is liquidity. What does it mean by financial market liquidity? I've always been aware of it as I got more and more into economic theory over the years. But when one of the greatest hedge fund managers of all time, Stanley Druckenmiller, he was George Soros's top fund manager who basically made a lot of billions for George Soros, Stanley Druckenmiller. He's a billionaire himself. He's quoted as saying that yeah, sales and earnings are important, but what moves stocks is market liquidity, like broad market liquidity. And where are we? What is the liquidity situation in the U.S. financial markets right now? The situation is kind of neutral. Like they're not pumping, they're not issuing checks, they're not pumping. They just had a Federal Reserve meeting. They did not cut interest rates. So they're not cutting interest rates because they kind of can't because of the inflationary worries, which I'm excited about talking with you about on Wednesday. talking about the what's the name of what's the day called? The day called? I know it's
It's
Tariff Day,
Liberation
but
Day. Yeah. Trump has
Liberation Day.
built this Liberation Day. I don't exactly know what we're liberating from, but he's coined this day as Liberation Day. The market is positioning itself heading into that day. And I believe, as we sit here, many people will listen to this after that day, but I still believe there's probably more questions than there are answers after Liberation Day occurs. But that's exactly what you want as an investor. Like, yeah, if we were recording this and delivering this to an audience of 65, 70-year-olds, there'd be certain things that we would talk about, but we look at our own analytics and we see that, there are some 65, 70-year-olds tuning into the program, but it's a minority of the people tuning in. Most people are in their mid 30s at the youngest, and into their mid 50s at the oldest. That's the widest group of people that are watching investment type of content, because they're still trying to build things up. You're still trying to get to your, whether it's $1 million, multi-million dollars, whatever it is, you're still trying to build yourself up as an investor. And so you're hungry for that knowledge. You're hungry for that edge. And I would just say, like, yeah, the last 2 years with the stock market up 30 some odd percent every year, and you had this great performance, that's great. And it's fun. It's fun to watch your account go up and those types of things. But these are the really exciting times where there's a fair amount of uncertainty from a macro perspective, fair amount of uncertainty from just an industry perspective. Certainly a lot of uncertainty around where this technology is going to take things. Are people still going to use Google search? I mean, 5 years ago, if you would have said that, it was pretty unheard of. And now it's like you can make some rather rational arguments around that. And so there is a tremendous amount of uncertainty around business models, technology. Trump is certainly not, helping the situation with a lot of uncertainty around tariffs, around cost cutting, around all these types of things. And so just broadly, you have this massive amount of uncertainty. So if you're a 65, 70-year-old, you have to sidestep that, because you don't know if it's going to be like the COVID V-shaped recovery in a week, or if it's going to be like 08, 09, and you're not going to get back to the highs until like 2012, 2011. So you've got to sidestep this thing. If you're a CNBC commentator and you're trying to attract that 70-year-old boomer that just wants to go on a cruise and have Josh Brown manage the money, well, you've got to speak to that guy. You've got to speak to the fear. You've got to speak to the uncertainty. And I think the key thing to understand is, if you're in your 30s, if you're in your 40s, even if you're in your 50s, the uncertainty is like a gift. The younger you are, the bigger gift that it is. And that you don't look back. Okay. Because during the last great financial crisis, I was in my 20s. I was in my 20s. I don't look back, John, and be like, damn, I should have waited until, April of 2009 to start buying rather than November, because I started buying the minute it started crashing. Okay. I don't look back and be like, damn, I should have waited 3, 4, 5 months. Should have waited for that extra 20% to go up. I mean, I probably started investing in the S&P, probably went down another 40% when I started investing and started buying stuff. I don't look back and be like, damn, I wish I should have waited. Wish I should have waited. And it's not that you need to have this like permanent FOMO type attitude, but you just simply don't do that. You just don't simply look back. What you often do 100% of the time is you look back and you're like, damn, I wish I would have bought more. Should have tuned out all the noise. Should have tuned out all the stuff. Now, that's not to say that you don't have a diversified portfolio. On a day like today, the markets were down big, or at least the NASDAQ was, the Dow was up. About half of your portfolio should be up on a day like this. Like, if you don't own some restaurant stocks and Home Depot or Lowe's, or if you don't own like a JP Morgan or a Wells Fargo, if like there are some people watching this where their whole portfolio is maybe a little bit of index fund, Nvidia, Palantir, Hims and Her Health, PayPal, that they've like centered themselves into like these stocks that either get talked about a lot or, or primarily tech stocks or primarily semiconductor stocks. And it's like, yeah, you're going to feel it if you are primarily concentrated around overvalued tech, overhyped stuff, or just strictly semiconductors. So just understand that, yeah, if your portfolio is Nvidia, Tesla, and Palantir, there are going to be times where your shit is down a lot, and you've got to be able to stomach that. If you can't stomach it, it's not Palantir's fault. It's not Nvidia's fault. It's your fault. You should balance that off with some REITs, some bonds, some gold. You know what I mean? Like if you add a bunch of gold coins or GLD or some gold miners, you're probably crushing it right now. So you've got to have a balance. If you can't stomach it, if you can stomach it, then I'm certainly not here trying to preach wealth management, because if you look at the richest and most wealthy people, they tend to have concentrated their wealth into one thing. There's actually not that many people that have built a huge amount of, and we're talking huge, like in where you're on the Forbes list, most of those people concentrated into one thing. Like Elon Musk got rich because of like one or two things. Now he's diversified a little bit, but he got rich because of Tesla and originally PayPal, but he took all of his PayPal money. He didn't go buy the S&P 500. He literally dunked it all off into Tesla. And if that didn't work, nobody would be talking about him right now. So, and then you look at other, Jeff Bezos dumped like his whole life into Amazon. You know what I mean? Now he's like doing other stuff, but he concentrated and centered himself into like really concentrated. So there is something to be said about having a portfolio that is Nvidia, Palantir, Supermicro, and Google or something. You know what I mean? Where it's like you have your whole net worth tied up in 4 stocks. Not for me, certainly not for me, but just understand that if that's you and you're listening to this and you're in 4 stocks, and even if it's $1,000 in your Robinhood account, I don't really care. You are going to have months like we've had over the past couple of months where you are going to see your account draw down 30, 40, 50%, just based on the fact that you are hyper concentrated in a small number of names. And when the broad markets sell off, it tends to concentrate around the names that people tend to center and pile into. Whereas like Boeing stock, John, nobody emails me about Boeing. Like we recommended Boeing like in December. I don't know what it's done since December, but it's probably either up a little bit or it's flat. And compared to a lot of other things, it's doing well. Nobody emails me about Boeing. Okay. And that is because nobody bought it. Nobody actually acted on that because they're like, Boeing, it's boring. It's struggled, this, that, and the other. Starbucks is probably in the same boat. There's multiple stocks that I've really enjoyed and really liked over the past couple of months that probably haven't done that bad, but nobody bought them because they want to be hyper focused into the big names. So if that's you and you're hyper focused into semiconductors, just understand your shit can go down another 30 or 40% from here. Nvidia could go down to 50 and it's still not, I mean, it's not like it's, free money on the ground at that price, based on some of the things we've talked about as it relates to gross margin, delivering the product, competition. We didn't really get into it, but there's a fair amount of competition coming from China and those types of things. And just the fact that they can't sell into that market certainly keeps a cap on the types of revenue that you're going to be able to generate. So just have that perspective out there as an investor. If you're broadly diversified, you're probably doing okay right now. Like, yeah, your portfolio's down. And if you're tick by tick on your 401k, it's certainly not up, but half of your net worth hasn't been wiped out. But if you're broadly concentrated into the tech sector, like you're absolutely getting smoked right now. And so you just have to understand that. Like that's part of the gig. It's like in golf. Like if you swing for that 400-yard drive every swing, you're going to hit a lot of bad ones. You're going to connect every once in a while, and you'll hit that 400-yard drive, and you'll have a great score on that hole. But there are going to be several other holes where you are completely off course, and you're going to have to deal with that. And just understanding that as an investor, if you're a newer investor, younger investor, just understanding that and take this time to plan things out. Look at this time that we're going through. If you're like my age and you're like 40 something, I always put myself through these scenarios and say, okay, what if I was 20 years older? What would I be doing right now? What would I have done 2 weeks ago, 3 weeks ago? Obviously in hindsight right now, you would have stepped aside, but you need to make those decisions. Need to understand how to make those decisions. You don't have to make those decisions now. And that's a big mistake that I see people make. 20-year-olds trying to manage their portfolio like they're 65. It's like, bro, just buy more. What are you doing? Okay. So, but it's good to run through these range of scenarios because when you're 65, something like this will happen again. And you just don't want to be caught off guard where you've got 2.5 million in your account. And then all of a sudden somebody gets elected or somebody says something or a COVID happens or whatever, and your whole net worth is wiped out in half. You just can't have that happen when you're 65. And just understand too, portfolio allocation. If you can stomach the 50% drawdown, then Nvidia at this price looks pretty good. Super Micro, any of these other companies, High Flying companies, Palantir, whatever, probably look okay. I was looking at SoFi today. It was trading at $11. I remember when it was 20 and everybody was telling me it was going to be bigger than JP Morgan. Now it's 10. Nobody's saying anything about it, So these things should get you excited when these stocks that if you liked them at 20, you better like them a hell of a lot more at 11. And so you got to be able to step in. And if you can't, it means you're not diversified enough. It means you need way more stocks in your portfolio that when you bought them, you literally hated them. Like a Boeing. I bought Boeing stock, John, and I was like, what the hell am I doing? What am I doing buying this company? You know what I mean? Like literally I'm buying this stock. I'm still buying Nike. And it's like, what am I doing? Why am I buying this? You know what I mean? But if you're not saying that, I actually don't think you're diversified enough. If you're not buying stocks and you're like, God, this stock sucks. It's like Starbucks. It's like, what? It's like nobody's going there. You know what I mean? And yeah, you're going to brick on some of these things, right? You're going to brick and some of these stocks will turn into IBM and they'll turn into whatever. You hope not BlackBerry or Blockbuster or something like that. But if you don't hate a portion of the stock, if you're like, because I see guys online, John, where it's almost like it's like their first girlfriend is their portfolio. And it's like, oh, they don't see any of the flaws. You point out any of the flaws and you're like, dude, that, it's like, that girl was with this guy and she was with this guy. And you point this out to a guy in love and he doesn't hear it. It just goes in one ear out the other. If that's how you are with your portfolio, you have to just understand there's going to be some ups and downs. Okay. And I don't have any problem with that. If you're completely in love with every stock that you have and you think it's going to a moonshot from here, no problem with that. Just understand you're going to have these big troughs where the darn thing is going to be down 40 or 50%. And in my experience, through the many years reading comments and interacting with investors, most people can't do that. Most people think they can do that until it goes down 40 or 50%. Then they sell at the bottom. So how you counteract that is you buy stuff that you're absolutely hating when you buy it. Doesn't mean you buy these stocks that completely suck, but you make educated decisions. And I think Boeing is a great example because it's like Boeing has like no competition other than like Airbus. You know what I mean? So if Boeing goes belly up, somebody's going to buy it just based on that fact. You know what I mean? So there is going to be some kind of put underneath it. It's not going to be, their business model is not going to be decimated like a Blockbuster. Okay. So you don't want to necessarily step in on these stocks and be like, oh, well, Blockbuster is down big. Yeah, because streaming is going to kill them. I don't see that necessarily with like a Boeing. I don't necessarily see it with a Starbucks. I certainly don't see it with like a Nike as well, where it's like 20 years from now, are people still going to be wearing Nikes? Probably. You know what I mean? Like, probably. I don't know where I was going with that. I was decimating people that are highly concentrated in like 4 names. But again, I don't want to discourage people. Like, if that's what you want to do, you can do that. You just have to understand, particularly as it relates to semiconductors, because I get messages all the time. It's like, hey, Colin, the stock that you recommended is down 30%. Well, yeah, of course. Everything's down 30%, except the stocks that you bought that you absolutely hated 2 months ago. Those should actually be doing relatively well. And on a day like today, even over the past 2 months, about half your portfolio should actually be doing somewhat okay. Otherwise, you do have to stomach the 30% drawdown, because it does happen. I mean, it's happened with every stock, whether it's Google, Apple, Microsoft, Amazon. These things have peeled off 30%. And if we're talking about semiconductors, stocks like Nvidia have peeled off 50% recently, like in the past couple of years. And so this stuff happens. You have to be prepared for it. I don't know if every investor is, but take these moments. These moments are great learning lessons to train yourself, train your gut. John, you certainly have many experience and many years at this. Any final, we've gone on for about an hour or so. Any final words of wisdom for the crowd out there?
Yeah, I would say that most investors are either not diversified enough. They have a handful of names that are just too aggressive, or they're all in the very, very aggressive category. And a big fund manager is just going to hit one button that sells all of them. If they're aggressive growth, they're just selling all the aggressive growth. And so it doesn't really matter what they do. So if you think you're diversified in a bunch of aggressive growth stocks, you're not really diversified. You basically own one stock now. It might as well be ARKK for that matter. Other investors are often too diversified. Like, you don't need to own the S&P 500. What you should have is do what Colin was talking about. Companies that you know really well, that are going to be around 5-10 years out if you're a long-term investor. Something that's going to be growing predictably, or is going to be part of the future economy. And if you're going to be a long-term investor, think about it as your house. So if you bought a house in Southern California in the early 2000s, or even the mid 2000s, come 2007, 2008, every house in Southern California, actually every house in California period, was down about 30%. So you take an $800,000 house and it's down to 500. Do you panic and sell? Do you do you go to Zillow every day and go, oh my God, my house is down $3,000 today? You would never do that. That's like crazy. Like, if you're thinking about long-term investing, think about it as your house. You're going to be in it for a long time. It's highly likely that it's going to be massively more valuable 5, 10, or 20 years out. You don't have to worry about, you sleep easy. You don't even look at it on a daily basis. Now, if you want to be more aggressive, or if you want to be more, take advantage of big swings in the markets, like I have done most of my career, then I would actually have a completely different account. I'd have one account, which is long-term investments in high quality, big blue chip names that are going to grow over the years and will bring that'll grow your wealth alongside with them. You're just going to participate in the growth of some of the greatest names in the United States. That's a wonderful strategy. I would have an account that just says just long-term investment account. I look at it maybe every month, maybe every quarter. I just wouldn't pay a whole lot of attention to it, just like I wouldn't pay a whole lot of attention to how much the house next door is selling for or down the street at any particular time. Shorter term, trading wise, I'd have a completely separate account. I would be more focused on being more nimble, being more anticipatory rather than reactive. Definitely not following the crowd, using technical analysis and listening to John, Colin, and my podcast going forward, because we speak generally in terms of like things that are developing, and we tend to catch them before most people, oftentimes before it shows up on CNBC oftentimes before Wall Street starts talking about it. So that's have a good source of information for your trading style. But I'd have two separate accounts there. I would think about them completely differently because they're two completely different skill sets. It's almost using like two different parts of your brain. Most people kind of mix them. Like, and if they do have a short-term investment that's not working, they're like, oh, I got to ride this one out now. Never let a short-term trade turn into a long-term investment. Like, have a time frame for your investments or your trades. If it's going to be a long-term, 5-10 years, have a time frame for how long you expect to hold it. If it's a trade, make sure you got strict risk management and exit those positions. Don't let a small loss ever turn into a really big loss. That's how traders get wiped out. Investors, completely different mindset. Warren Buffett, Charlie Munger, if the stock's down 50% and they got conviction in the future growth of the company, then they're just, they're not concerned at all. So two different mindsets. Be very, very, and Colin's been saying this brilliantly for months now, which is have a strategy. Most people don't have a strategy. They simply hear a story. This is the next Tesla. This company's sending rockets to Mars, and this, not that there's not a whole lot of companies doing that. Definitely wasn't a dig on SpaceX. But they're always looking for something that's the next this, the next that. It's usually a really sexy story, and have no idea about valuation, no idea about how you're going to handle fluctuations. Never have a price target. What's a price target? Well, it's going to the moon, of course. Well, that's not a price target. That's not a reasonable price target. And most importantly, don't have an idea what to happen. Be prepared for market environments like this. Look at Colin and I right now. We're like completely unfazed. We're looking for opportunities. Like, we're not shocked by anything that happens on a day-to-day basis. Sometimes a random tweet from one of our two country leaders right now might have shock value to it. But we're never shocked. We're not surprised. We're not surprised that the market is down 10% or down a little bit or down a bunch in a particular day. So be prepared for it. Be mentally prepared for it. Be emotionally prepared for it. Have a game plan. Have a strategy. That's the most important thing. That's how you're going to build your wealth, either with your long-term investments or with short-term trading.
Yeah, I would say like have some people call it like a thesis. Have like a vision. You know what I mean? I see these people, they go find some chart that the company has, or they go find a quote that the executive has, and then they repeat it. You know what I mean? Like one of the ones that has come across recently is like, I was looking at SoFi. This was, 10 points ago on the stock. And I was like, I don't know. This is just a bank. You know what I mean? And I got like 50 people be like, nope, it's more than a bank. And I was like, I don't know. Like, who's saying this? Who's telling you guys this? Where did you develop this thesis? And I would ask these people this, and they wouldn't say anything, because it was like, that is what they've been told, that it's not a bank. And it's like, yeah, they don't have branches, but that means they have to sponsor really expensive Super Bowl, or like they have to sponsor really expensive stadiums because they don't have branches. So they're still spending the money. The money still has to be spent. They're just not spending on branches. They're just sponsoring SoFi Stadium in Los Angeles, and they're buying, advertising on social media sites or something, or they're buying you as a customer by paying a higher APY for the checking account. They're paying for this one way or another. And so like, develop your own thesis. Stop listening to what the management says. It's okay if like the management tells you and you buy into it. There's nothing wrong with that. Nothing wrong with I watch every one of Jensen Huang's keynotes. I listen to all the conference calls of all these companies, but I'm still piecing this stuff together myself. And just understand that first of all, your thesis can change over time. Your vision can change over time. Also, just understand that the market will not agree with your thesis a lot of the time. And currently, that's how I sit here as it relates to AI. I have a vision of what's going to happen with AI. I still think we're in the very, very early stage and the early innings of that. Fair amount of investors don't. And I think it's largely because there's a fair amount of people that don't have time to watch the vision play out. They're my parents' age, and they could care less if AI cures cancer or not, because by the time it does, they will have either died of cancer or died of natural causes. So it doesn't matter to them. Okay. So you just have to understand that a portion of the market, especially if you're a long-term investor, doesn't have time for your vision to play out. And so there's going to be a fair amount of time where these stocks are going to sell off, and you're going to be like, why is Nvidia selling off when these companies have to spend another $1 trillion just to get to the point where they can deliver memes, let alone something useful from this AI shit? Okay. So it's not, the stuff that's not going to agree with you 24 hours a day, 7 days a week. When it does, it feels great and you feel like you're Warren Buffett Jr. And when it doesn't, don't get discouraged. Doesn't get me discouraged at all that these stocks are down. In fact, it's the opposite. It's like, wow, I'm looking 20 years down the line, and things are looking really good at this point, particularly at these prices. And so, yeah, I tell you what, John, the state of AI, I think, is in very, very, very good shape. I think if you look anecdotally across the board, that there is a ton of evidence that this stuff hasn't crossed the mainstream. And as it crosses into the mainstream, that there's a huge amount of demand for it. There's a huge amount of demand for the average person to make a meme with AI. Now, I know that's not curing cancer. That's not saving the world, but that is a big business. Okay. The fact that, and that is requires at this point, a large amount of compute power. These hyperscalers are literally having to spend billions of dollars, just billions of dollars, just to meet the meme demand. Just to meet meme demand, tens of billions of dollars of compute have to be built. And we say that, it's hard to say that with a straight face, but that is the reality. So now as we move forward, John, somebody wants to make like a 30-minute video with AI. There's no way in hell there's even close to the amount of compute needed. One person, sure. But the general public out there wants to make a 30-minute video where they plug their kids into it. They plug a soundtrack and they do some stuff. Like, there's no way there's enough compute. And that's the direction we're going. Just like, John, back in the internet, when we first got on the internet, there was not enough compute and there was not enough bandwidth to play a video, let alone do what we're doing today. It took like 20 years for like the internet to get built out to where we could have a conversation and like it wasn't all grainy and it wasn't like a 2-minute video clip. So things have come a long ways. And I still think we're probably, on that path where you have a 20-year path of sustained investment in AI. And, with curing cancer as the bar, you have a large amount of investment that is going to be needed. And with that vision, that is just my vision. I could be wrong. Maybe. I don't think so. But with that vision, I am very comfortable watching these stocks pull back. In fact, I'm very excited about it. And in fact, I haven't been this excited in a while about the stock market, because I think this is creating one of the greatest wealth building opportunities. This is like houses, John, selling off 30 or 40%. My God, I'd be thrilled. I have a house, and if it peels off 40% in value, that would be one of the greatest things that's ever happened to me. Okay, because there'd be about 4 other houses that I want to go buy closer to the ocean. You know what I mean? And so I have the same attitude as it relates to stocks. There's a lot of stocks I want to buy, positions that I want to have. The further they go down, it's like oceanfront real estate in California going down in value. Wouldn't care if my house went down in value. If there's going down in value dollar for dollar, I'm excited about that because it means I might be able to go and afford it. Yeah. So this is our podcast today. We'll be back again with John. We'll talk about some trading strategies going forward. We're going to be going live on Wednesday. We'll be talking about the macro economy, depending on how that plays out and how that story kind of unfolds. Could be a lot of macro discussions that we have here on the podcast as well. I ask all of you, if you've made it this far, please like the video, consider leaving us a comment. Considering if you're listening to this on a Spotify or an Apple iTunes or podcast app, you can leave us a review. That would be fantastic. That would help our show out and help us continue to deliver high quality content in the future as well. John, any final words for the investors out there?
I don't know. I've had a lot of fun with you today, Colin. I think we shared some insights in some of the conversations we've had. And I just want to wish the listeners or the viewers the best in your investments in this. Take advantage of some of these opportunities in this market. Exercise some patience. These are the kind of markets that can build your wealth over time. Make the most of them.
Make the most of it. Okay, John, thanks for joining me, and people will be seeing you quite a bit more here on the channel. We'll get you on video at least once a week going forward, I think.
Looking forward to it, Colin. Had a great time with you.
All right, John. We'll see you.